something interesting in the conference board data. You can split the questions that people get asked in two categories: questions about how you presently are doing, and how presently the economy is doing, versus what do you think is going to happen in the future, in the next 6 months to a year. And if you look at this picture, it shows you that in terms of the present situation, how things are right now to you and people around you, the respondents are actually pretty content. But in terms of expectations for the future, they are not looking as optimistic. They're not looking as happy. So why is that? Well, it's because of a couple of reasons. First of all, if you ask yourself, how am I doing now? A lot of us probably will feel, relatively good, because our net worth for most of us actually has been on a pretty nice trend for the past year or so. This picture shows that the net worth for people across the wealth distribution has increased since about a year ago. So our assets minus liabilities, that number that's been looking better for all of us, so we feel richer. So presently we're pretty happy, which is what I think that confidence, that conference board present situation number captures. Another thing to look at is, the value of our homes. For a lot of Americans, a lot of their wealth is captured by the value of their home, and homes have increased in prices dramatically, of course, since COVID. There's been in the past few months, a little bit of a plateauing in home prices, but still, well, many of us who are homeowners sit on an asset that's worth way more than just a few years ago. So, people's net worth, people's assets are worth more. And probably this has impacted consumer spending, and which we've seen grow quite a bit actually over time. This is a picture that's showing you in the blue line the rate of growth of spending, personal consumption expenditures in real terms. The orange line is the growth rate over time in real personal income. And basically that blue line has a pretty good slope. So consumer spending has been healthy, has been growing in real terms over time. Now the orange line tells you that while people were spending more and more in real times, yes, they were also earning more and more in real times, but uh, the pace of spending growth was higher than the pace of real income growth, right? So if this is happening, you're depleting your savings, right? Or you're maybe borrowing against those assets that increased in value. So when people are having to think about the future, which is the other piece of that conference board's index, thinking about the future, they might be saying, well, we've been spending a little bit faster than our real incomes would have allowed for it. Probably we have drawn down some of our savings, and that's a little concerning. And indeed, there's data just came out of JP Morgan Institute that shows that for a lot of people, especially lower income individuals, the all of those excess savings that came from pandemic stimulus money, they're gone, right? And people have reverted to their normal savings rate. And this is the data from JP Morgan, is actually matched very nicely by the personal savings rate data that we get um, from the government. And if you look at this personal saving rate, nowadays is going back to a pretty lowish number. That's in line with historical trends. And so basically people are back to before the COVID excess savings. So households probably are indeed concerned about their future situation, because their savings are a little bit lower. They might be concerned about wage growth. Remember that they're not hopping job from one job to the other as much as before, based on the quits rates from JOLTS. So households are cautious. The one last thing I'll say about data from these consumer surveys is it should be good news for the Fed and everybody else. This is data from Michigan. It's showing you what are people's inflation expectations 1 year ahead and 5 years ahead. And what I want you to take from this picture is that both of these expectations for short run and long run inflation are well anchored. They're around 3%. It's a number that's above the 2% Fed target, but it's basically in line with historical expectations of consumers. So we're in an environment now where households expect inflation to not be at just unbelievably high levels. They expect it to be where they always thought it would be, which is about 3%.